The first question we will go through is the card, the question card to be reviewed. It is one of the questions under the topic business finance. And here we will go through the cost of equity calculation, also go through the calculation of the beta, the asset beta, how to turn the asset beta into the equity beta, which is the way to find out the project specific cost of equity. And also we will go through to discuss discussion topic, which is what the first one is the DGM, the different growth model and the capital asset pricing model. The other one is about the capital structure theory. So we start part A and B first. And here is the question. You can go through it, and then we will come. You can come back to listen my explanation of these questions. Okay. So here, this company, card company, issued 8 million shares, and the market value of per share is $7.16, which is an ex-dividend price. A dividend of 62 cents per share just paid, and the pattern of recent dividends is illustrated in table here. Okay. And the company here is about the equity. The next paragraph is about the bonds, the redeemable bonds, which is 8.5% redeemable bonds in 5 years' time, and the nominal value is 5 million. And how about the market value? The market value for each $100 bond is $103.42, and the redemption will be at nominal value. Here is the redeemable bond or the bond. And the next paragraph is about the card company investment plan, which it plans to invest in a joint venture, which is a new business area, so that it is completely different business risk in which the company is now working at. So the new business can be benchmarked with a proxy company with similar business risk, and the equity beta is 1.038, okay, which is financed by 75% by equity and 25% by debt on a market value basis. Okay, market value basis. So the assumptions given to you is the risk-free rate at 4%. The equity risk premium is 5%. The card company pays profit tax at 30% per year and has an equity beta of 1.6. And here I need to explain the equity risk premium. The equity risk premium should be the expected market return minus the risk-free rate. So here is the equity risk premium. All right. So according to CAPM, the capital asset pricing model, and a company's cost of equity can be found by the capital asset pricing model, which is the risk-free rate plus beta of this company's stock times the equity risk premium. Okay, so here's the capital asset pricing model. So the information given is given to you, and then the first part, part A, requires to calculate the cost of equity for this company using dividend growth model. Only 3 marks, so you are expected to spend less than 6 minutes to complete this question. So it should be fast. By checking your formula sheet, you should know the dividend growth model, the DGM. The formula is the period run dividend, or the D-NO, times 1 plus the growth rate divided by P naught, the current price, plus growth rate. Okay, so G is the growth rate, the dividend growth rate. And D naught is current dividend per share. P naught is current price per share. So the information given to you here, you can find the growth rate. Okay, the growth rate, how to get the growth rate. The growth rate, for example, if you check the information given to you, the latest dividend per share is 62 cents here. And at 2010, the dividend per share is only 55.1 cents. So it should be 62 minus 50.1 divided by 50.1. Okay, I need to plus 1, or in a simple way, it's 62 divided by 55.1. And how many years? Okay, let's check. It's 3 years, right? Okay, here is 1 year. Here is second year. And here is the third year. So the 3 years period. So the exponential function is 1 over 3. And then from this number, you can minus 1 to find the growth rate, which is 4%. So based on the growth rate at 4%, you are applying the dividend growth model, which is provided by in the exam. Then you can get the return on equity or the cost of equity, which is the dividend should be 62 cents. 1 plus G, which is 4%, and divided by the current price. What is the current price now? The current price is $6.16, right? So based on this formula, you can get, which is 9% plus 4%. So the final solution is the return on the capital, the cost of capital, the cost of equity is 13%. 3 marks. Is it easy? I think it's not that very difficult. So if you can find out the growth rates, because the most challenging part may be the growth rate, because some students are confused or using the wrong number of years here, so that they cannot get the correct answer. But in general, it's not a difficult question in examination. So here's part A. First, we need to find out the dividend growth model formula, and next part is to find out the growth rate. When you solve the growth rate, you can find the cost of equity here. So move to next part. The second part, part B, the requirement is discuss whether dividend growth model or the capital asset pricing model should be used to calculate the cost of equity. So we need to compare which one should be better. And here, the DGM, the most challenging, the easiest part is you can get the dividend, the current dividend, the current price easy because they are known variables, which you can find in the market. And for G, the dividend growth rate, it is a bit tricky or challenging here because what we did in the part A is we found the historical dividend information or dividend growth rate, right? It's from 2010 to 2013, but it's not the forecast growth rate. Okay, it's not the forecast growth rate. So in other words, we assume the dividend growth rate in future is the same as in the past. So here is the assumption of what we did in part A. It's not reasonable. Okay, it's not reasonable. So for DGM dividend growth model, the most challenging part is to find out the dividend growth rate. The most challenging part is to find out the dividend growth rate, which is, for example, we based on the history to find it out. It's not reasonable or realistic because in the future we should focus on the operations, the cash generated from the business, so that we can find the forecast growth rate instead of to use the historical growth rate replacing the future growth rate. And how about the capital asset pricing model? For capital asset pricing model, in theory, it is better, or theoretically, is superior to dividend growth model. Okay, in theory, it is superior to dividend growth model because the cost of equity of a well-diversified share and for capital asset pricing model, the CAPM, in theory, it is better. Theoretically, it is superior to dividend growth model. Okay, because it assumes the investors or shareholders hold a well-diversified portfolio and systematic risk considered. Okay, so it assumes the investors hold a well-diversified portfolio and systematic risks are considered. But the problem is, okay, we're checking the formula. Here is the cost of equity, which is equal to the risk-free rate plus the beta, for example, beta I, times the expected market return minus risk-free rate, which is the average equity risk premium. And here, the most challenging part is the beta. Okay, for the beta, it's based on the history, the share price history. The historical share performance. Okay, and the share performance and the stock market performance and the market performance. So, for example, the market performance with the share performance, we got the beta is 1.2. Okay, but it is only valid maybe at say last year. And this number is dynamic. Okay, it means it's changed every day maybe. And finding the beta is not easy. Okay, finding the beta is not easy. Finding beta is not easy. In addition, the other parameters, say the risk-free rate and also the expected market return, for these two parameters, it's also at the debate, always debating which one should be chosen as the risk-free rate or the market return. For example, the risk-free rate, whether we should apply or we should adopt the US 10-year Treasury bonds as the risk-free rate, or we should adopt other financial instruments as the risk-free rate. So here is the challenging part in these questions, in this formula, in this CAPM. But in theory, it's superior to DGM because the risk is considered. For DGM, it's just based on some history or historical dividend growth rate to project or to estimate the cost of equity. But for the CAPM, for the capital asset pricing model, it considers the systematic risk, which is quite important in the modern finance theory. So here is shared to you about the discussion on these two theories. The first one is dividend growth model. The other one is the capital asset pricing model.